Hey guys, welcome back to Market Signal. Today's video, I'm going to focus on a stock 30 times your money in 1 year. Not NVIDIA, not even a crypto play, but a flash memory storage company that most people had never even heard of. A spinoff that was trading for less than $30 a share during the tariff panic is now sitting at $852 a share. The stock I'm referring to is SanDisk, ticker SNDK. In today's video, I want to ask the question that almost no one seems to be willing to answer out loud. Is this trade real and durable, or is the clock quietly ticking away on everything that made it possible for SanDisk? I briefly covered SanDisk in yesterday's video, but today I want to dive in deeper because honestly, it is one of the most interesting trades of all of 2026. And the more you analyze this stock, the more you realize that it is a company that has clearly two legitimate endings this year. Which one will play out? It all depends on the decisions that are being made right now in labs and boardrooms in California, Japan, and South Korea. That's what we're going to focus on today's video. We're going to dive in and we're going to cover SanDisk deeply. So if you haven't done it already, hit like, hit subscribe to the channel. Let's get started. Before we get started, we have to go back to when the combination of Western Digital and SanDisk came to life. So Western Digital acquired SanDisk back in 2026 for $16 billion. And for years, investors just hated this combination. You had two counter-cyclical businesses masking each other's value within the market. Finally, activist investor Elliott Management eventually forced a split between these two companies. And on February 21st, 2025, SanDisk officially relisted as an independent company. And within 6 weeks of that relisting, the stock hit an all-time low of $27.89 a share. The market clearly decided a pure play NAND provider, a commodity company like this without any other diversification, just wasn't worth much at that time in the market. But then everything changed at once. AI data centers started devouring enterprise SSDs. Let me show you the inflection point that was, or what the impact was for SanDisk. If you look down below on the right, you see the movement from the stock from when it first relisted in April to where we are today. A 30x movement in the company, as I mentioned in my opening. Trading at just under $28 to finishing in that $8.52 a share. Look at that explosive growth in that 1 month time frame. That's the example of a parabolic move with the stock, if there is ever an example of it. That's why I said it's one of the most interesting trades in all of 2026. Huge movement overall. That was the inflection point that the company saw. We saw data centers just devouring memory, but also we saw major memory players start to pivot. They started to pivot away from NAND. They started to starve the NAND supply in the market because they were focusing on high bandwidth memory. They were clearing clean space to create more capacity for high bandwidth memory due to the pricing power, due to the higher margins of that product overall. So SanDisk was able to step in at that time as the pure play NAND provider. They met the moment in the market, and that's why we saw that huge inflection point overall with the company. We also saw massive moves financially. Let me show you what we saw in the Q2 earnings for the stock. You can clearly see on the graph, whether you look at Q2 of 2025 versus Q2 of 2026, 61% growth in revenue. Went from 1.8 billion and just over 1.8 billion to just over 3 billion overall. Gross margins were at 30% roughly in Q2 of 2025, grew up to over 51% a year later. Huge movement overall. And then we look at earnings per share. If you can see it down at the third one from the bottom, roughly SanDisk was always trading this $1.22, $1.23. It was actually below that too earlier, under $1 at earnings per share. They have now had $6.20 earnings per share in Q2. Let me show you what they guided for Q3, because this is a huge part of the story as well. Revenue first is guiding towards 4.4 to 4.8 billion, up over 3. Remember that? And that was a huge move from the prior quarter. But if you look at earnings per share, which again is the second from the bottom, $12 to $14. This was a stock or a company that was under $1 not that long ago, then traded in the $1.22, $1.23 range, jumped up to $6, and now we're going to see that double again when they report their earnings on April 30th. I think you might get above that, quite frankly. I think you might be higher more closer to the $14 earnings per share. What we're looking at moving forward is they're guiding, or many analysts estimate them for quarters beyond this to start to get into the $20, $20+ range of earnings per share on each individual quarter. Guys, this was a massive move for SanDisk overall. I mean, their revenue went from 1.9 billion in Q4 of 2025 to just over 3 billion in the last quarter they reported. That's a 61% year-on-year growth, as I mentioned. Gross margins, which had turned negative for the company in 2023, when the company was burning cash, are now guiding to 65 to 67% for Q3. Q3 revenue guide is 4.4 billion, 4.4 to 4.8 billion, and earnings per share, as I showed you, is 12 to 14. A year ago, those numbers would have sounded like a fiction story for SanDisk. So the 30 times return makes sense in hindsight now. NAND pricing power, enterprise SSD demand, the appetite that the hyperscalers that had for that, the AI data centers had for that, and SanDisk being the cleanest pure play AI storage company in the US market overall, that was a massive move. They met the market at the right time, as I mentioned. The fundamentals re-rated first. The question is now is whether those fundamentals are durable. Can they sustain them moving forward? And I think there's three questions that we have to walk through together to help us answer that. First is all focused on pricing power. Is the pricing power that SanDisk has in the market right now, is it real? This is the bear argument, clean and simple. The NAND has always been a vicious commodity cycle. We saw the short sell that Citron Research had on them maybe about a month ago. They were arguing that Samsung will prioritize market share over margins and will flood the supply with NAND memory. Samsung, we know, has historically sacrificed margins for market share in the NAND area. Any decision to prioritize volume could jeopardize SanDisk's 65% plus gross margins. It has happened typically in every prior cycle. The structural counter argument to the bear case, though, is this. This cycle has two features the previous cycles didn't. First, AI data centers. They're signing multi-year supply agreements right now. And they're signing those for enterprise SSDs and for NAND products. These are not quarterly orders anymore. This is a fundamentally stickier demand that we see in the market. The second counter argument is that NAND bit demand growth is running at 20 to 22% against the supply growth of only 15 to 17%. Multiple sell-side desks model that gap persisting until 2028. My personal take, I think pricing power is real for 2026 and most likely into 2027. I think the cycle risk story overall is really for a 2028 and beyond timeframe. Now, the second question we have to ask on SanDisk is the valuation justified? And this is where it gets genuinely interesting. And I want to show you some data that I pulled from TradingView that just looks at right now. Let me change that view. You can see the price target that TradingView has. The average is 832. You can see below that the parabolic run with the line graph that goes up to where we stand today at 852 a share. But you can also, and let me change the view to make it a little better. Maybe you can see this better. But you can see the range we have between mid and max on the price targets. Obviously, the Bernstein target came in last week of 1,250 a share, and we have the low of 650 a share. If you look to the right of the 24 analysts right now at SanDisk, we see that 14 of them are strong buy, 4 are buy, and 6 are hold. So clearly that sits in that buy to strong buy range. But that is a massive gap that we have still have for the stock of about a $600 difference between low and high overall for the rate. Morningstar has traditionally been the bear case for SanDisk. Their fair value history tells a story on itself on how they've moved recently with this stock. Because before Q3 2025 earnings, the fair value that Morningstar had for SanDisk was $40 a share. After the Q3 earnings, they raised it to $135 a share. After Q4 earnings of January of this year, they raised it again. This way, all the way to $670 a share. They tripled their estimate in 6 months because the earning trajectory forced them to do it. Here's the one thing that Morningstar has not changed, and even with all of those upgrades, their economic moat rating. It's still rated none. Their core argument remains that NAND is a commodity. SanDisk has no durable pricing power, and today's margins will eventually compress. That's the bear case in its purest form. Not that the stock is wildly overpriced, but the market is treating a commodity company as if it's proven something it hasn't yet. So the next question is just around that, the moat. Is the moat defensible for SanDisk? And I think there's three pillars to this argument overall. The first pillar sits with the Kioxia joint venture. We know that that joint venture has been extended out now to 2034. Kioxia is the inventor of flash memory. This is a bullish argument for SanDisk, the fact that they've extended this partnership for another decade. It gives them the manufacturing scale to compete with companies like Samsung. The second pillar is based on their aggressive move to enterprise SSDs, the data center movement overall. And in their most recent earnings, I think it was about $440 million in revenue right now for it. They're trying to shift and grow that overall. So that is their second pillar, I would say, around this is the moat defensible. And the third is a huge bet, a moonshot bet, we'll call it, on high bandwidth flash. That technology bet, which I'm going to cover in its own section in a moment, because I think it is worth that level of just dedication to the story today. But the Kioxia extension, the partnership that's going out to 2034, that is clearly the most concrete structural advantage for this company. The enterprise SSD push is smart, but currently it's only about 15% of the overall revenue for the company. And then the high bandwidth flash, that is their wild card. Here's the problem that high bandwidth flash is solving. Let me show you a picture, because when you can see it on your phrase, you see that AI systems use memory in a hierarchy. At the top is high bandwidth memory, which sits right next to the GPU. It's fast, it's expensive, and it's capacity limited. At the bottom are SSDs, cheap, high capacity, but slow. As AI models get larger and inference workloads scale, the gap between high bandwidth speed, high bandwidth memory speed, and SSD capacity is becoming a real bottleneck. You can see in your picture what high bandwidth flash from SanDisk and from SK Hynix is attempting to fill is that gap, is that bottleneck. A new memory class that targets comparable bandwidth to high bandwidth memory while delivering up to 8 to 16 times the capacity at a similar cost. They're also going to leverage SanDisk's BiCS NAND technology with CBA wafer bonding. That is not a marginal improvement. That is a different product in its own category entity overall. And when we take a look at what's happening overall with it, you can see that SanDisk and SK Hynix began global standardization of this memory overall. So what does that mean to us as investors? They have held formal high bandwidth flash specification standardization consortium kickoff at SanDisk headquarters in Milpitas. They launched a joint work stream under the Open Compute Project, the same standard body that governs data center hardware for Meta, Microsoft, and other hyperscalers. When something enters the OCP standardization, the biggest buyers in the world start to pay attention. The timeline is pretty concrete overall. The first high bandwidth flash samples are targeted for the second half of this year. First AI inference hardware incorporating high bandwidth flash is expected in early 2027. That is an imminent catalyst, not a distant roadmap for the company. Now, the honest risks overall is the OCP standardization doesn't guarantee adoption. Samsung has its own competing flash back storage initiative, and NVIDIA's GPU roadmap is deeply tied to high bandwidth memory. So convincing hyperscalers to redesign architecture around HBF is a multi-year process, even if the technology works perfect. High bandwidth flash is a legitimate shot at structural differentiation for SanDisk, but it is a 2027, 2028 earnings story potentially. It is not a 2026 story for the company. So we have to shift gears now and take a look at this China showdown that I covered a bit yesterday in the video as well. 4 companies that we track on this channel: Micron, SanDisk, Western Digital, and Seagate. Of those 4, SanDisk is the most exposed to what China is building right now. I covered this picture a bit on the story yesterday, but clearly Chinese memory giants, you remember I was saying, they're scaling fast. The AI boom is giving them cover. The one in particular that I mentioned SanDisk needs to focus on is YMTC. So YMTC is the pure NAND provider in China as well. They are building solutions. They are building fabs. They are moving fast with a goal to be the world's third largest NAND provider, passing SK Hynix, passing Micron this year overall. So if you just think about it, YMTC had a 10% global NAND shipment share in the first quarter of last year. By Q3, it had climbed to 13%. A new Wuhan facility is on track for mass production in the second half of this year, at which point analysts project them they will overtake SK Hynix and overtake Micron to become the world's third largest NAND producer. The standard response is that YMTC is technologically behind. It can't compete with SanDisk and premium enterprise applications. And that's partially correct, but it's a dangerous comfort blanket for SanDisk to have. And let me show you why. Because when we go back and we think about their earnings, let me change the view so you can see it. What SanDisk is mentioning is that YMTC can't compete in the data center view. And even if that's correct, that's only 15% of the company's revenue. Look at Edge and consumer where they can. That's 85% of the company's revenue that could potentially be at risk if YMTC can build supply and start to bring significant NAND supply to the market. Because YMTC doesn't need to beat SanDisk in AI data centers. It needs to undercut SanDisk in budget consumer storage, edge devices, and lower tier enterprise market where SanDisk still generates significant portions of their revenue. The design win argument is what Wall Street is missing. HP and Dell, as I mentioned yesterday, are already evaluating Chinese memory suppliers during this storage phase right now. Those customer relationships don't automatically reset when supply eases. Stickiness works in both directions overall. The Match Act, introduced in April, just a few weeks ago with bipartisan congressional support, is trying to be quickly pushed through both houses. It specifically names YMTC as a covered facility that would block both new sales tools and servicing of installed equipment. If it passes, it caps YMTC's technology trajectory over time. Near term, that's bullish for SanDisk's competitive moat. But we have to be clear, the act has not passed yet. YMTC's Wuhan facility will come online before the law takes effect. And legislation of this complexity typically takes 12 to 24 months to clear. So don't price in the Match Act yet as anything of certainty in the market overall. The threats are real for SanDisk. The opportunities are real as well. So let's go over and just cover what my verdict will be as we think about all the scenarios. And here's how I think about SanDisk. Right now, it's currently trading at $8.52 a share. Let me show you a picture I put together to demonstrate that. And clearly, you can see right here, we have a bear case, a base case, and a bull case for the stock. And the bear case is easy, right? It clearly shows that if NAND pricing peaks in late 2026, Samsung opens supply in 2027, and YMTC takes the low end, high bandwidth standardization stalls. This is all what would happen to be the bear case for the stock. Margins would compress back to 30%, stock re-rates to a commodity multiple. The 30-time return was the whole trade. If we look at the base case overall, this is saying that the mix shift to enterprise SSDs continue. Data centers reach 35% of the revenue instead of 15% today by 2028, and multi-year contracts reduce cyclicality. NAND stays structurally elevated and with persistent demand, and Match Act pauses and caps YMTC's growth. High bandwidth memory isn't a major revenue driver yet, but it is in validation, maybe with a few hyperscalers. This is the consensus bull case, and at current prices, it implies a moderate and real upside. And then finally, the bull case on the right. This is high bandwidth flash achieves hyperscaler valuation next year. NVIDIA, AMD design into it with their next generation inference chips. SanDisk becomes the sole supplier of the memory category, justifies the DCF fair value, showing in models between $1,500 and $2,000 a share. This is probably the lowest probability, but it's not a science fiction story based on everything we're seeing in the market overall right now. So guys, that's the three scenarios that I see overall. If base case plays out, it's fairly valued or cheap here. If bears start showing up in the data, it moves down hard and fast. Remember, SanDisk has a beta of 2.85. That means this stock will not pull back gently if any of that bear case comes to fruition. So I'm looking at April 30th, their earnings date at the end of this month. I'm watching two things specifically. Not a headline review of revenue. That's already baked into the numbers. We know that. First, I want to see is what does management say about the pace of customer migration to multi-year contracts? And then second, is there any language about competitive pricing pressure from Asian suppliers, particularly YMTC, if they name them by name? Those are the two answers that will tell us more about the durability of this business, more than any other EPS or revenue number as a whole. SanDisk is one of the most interesting risk-reward conversations in the market right now, precisely because both the bull and the bear cases are completely defensible. This is why I said it's one of the most interesting trades in all of 2026. But we have to remember, the 30x move is behind us now. What's in front of us for SanDisk is a company with 18 to 24 months to prove that it can convert a commodity windfall into something that's durable and sustainable. The April 30th earning, the Q3 earnings, that will be our next data point. I will be back after that with a video that breaks it down completely and gives you my insights into those earnings. But until then, I want you to drop a verdict in the comment below. Are you more aligned with the bull, the base, or the bear case that I laid out just a moment ago in a picture? I'll read each and every one and respond to me as a no, but I'd love to hear your thoughts on SanDisk overall. Where is your sentiment right now? I hope you have a great Sunday overall, and I'll see you guys in the next video. Take care.